Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. And today we are jumping into part 10 of our series of where we're going through Nelson Nash's Becoming Your Own Banker. And today we're on page 68. If you guys are following along in the book, great. If not, make sure you guys jump on the website, go get that. We'll have a link in our show notes. But if you're not following along, feel free to jump in and listen to this podcast. You don't have to start at the beginning. It's a good place to jump in here and listen along. So let's get started, right? On page 68, what Nelson talks about is the cost of acquisition is the title of it. And for me, when I think of this one, the first thing that comes to mind is one of the probably first objectives that people have when they think of infinite banking concept, which is a slow start. Would you agree?
Yeah, I think that's probably the biggest obstacle that people have is, which we call the slow start, meaning like you put $1 in the policy, you don't have access to that dollar in all that dollar in the first year, and people get hung up on that, and I can totally understand. But what we're going to share is how we address that. And what I would say is, if you're focused on the short-term results, then infinite banking is not for you, right? This is a long-term strategy. So the way that one parable that I use is I relate it to getting a education. Now, let's use you for an example, Cameron. Like,
why not?
Right? Yeah,
why stop now?
This is about to get good.
Exactly.
Right?
Let's
so
go.
when you went to college, and I know you got a degree for physical therapy, or you can talk about your bachelor's degree or the Paul Mitchell School, but actually, since you dropped out of that, Paul Mitchell, does that mean you're a beauty school dropout?
No.
Right? Well,
Wow.
it doesn't matter. It doesn't matter. But when you went to school for physical therapy, and how long did it take you?
4 years.
Okay.
Undergrad.
Over those 4 years, how much money did you make as a physical therapist?
I made zero because I was still a student. But
Right. So you spent 4 years of your time, and you made $0.
that's right. Yeah.
Right. And to make it even worse, your school, I assume, wasn't free.
No.
Right?
Not at all.
So you had to pay to learn, and during that time, you earned $0.
Yes.
But then eventually, the goal is that you get out of school, and now you have the education and the experience to start making money. So I tell people it's the same thing as if you're going to invest the time for your education. What we're doing here is we are investing in yourself inside a policy. And and another example I like to use is related to business. Most businesses aren't making money from day one, right? It takes some time. They have to invest some money and some time to actually learn and get that business up and running. And I'll use an example. We are flipping land. We're using the Land Geeks a course. We paid money to go through that course. So that took time and money over 16 weeks for us to learn this process. And I think we started this actually, say, in April, or let's just say March. We didn't make our first sale to actually yesterday. So this is August of 2020. So we invested probably about, I think, total of $18,000 is what we have invested so far. And our sales are $3,500.
Okay.
Now, if you just look at that short-term result, that sounds terrible, right? But we're not looking at it just at the short term or today. We are creating a business. And so it's going to take time. It's going to take money and time to learn about this. And in any business somebody started, they're not profitable at the beginning. So in essence, what we're doing with infinite banking, we're making our own, we're creating our own business, our own banking business. So it's going to take time in order to do that. Cam, how do you explain?
How do I explain slow start?
Yeah.
Yeah. Is very similar to what you did. Is
Of course.
but much better, by the way. So when I'm talking to a potential new client is, right, one of the questions I have is, what are the pros and cons of this? And I will share with them up front, and I'll say, listen, if you are focused on short-term results, this is not the strategy for you, right? Is because if you are focused on the way that I'll say this is, hey, are we planning for year 1 or are we planning for year 20? Right? Is because if you're looking for the maximum amount of returns over the next 12 months, then listen, I'll make some introductions for you, but I'm not your guy. Right? And what I'll do is I'll pull up an illustration, and I'm very deliberate on this when I'm talking to somebody early on, is I will pull up an illustration and I will go through the first year's premiums and how much cash value they have, the second year's premiums and how much cash value they have, and the third year's premiums and how much cash value they have. And the reason that I go through those first 3 years is because, like Anthony mentioned, is that first year it's a slow start, meaning, hey, if you put in $1, you're going to have probably 60 to 70 cents that's available for you, right? The second year, that's going to get a little bit higher, but it's that cost is associated all the way through the third year, and typically that fourth year is when you're 100% cash flow positive on an annual basis, meaning you put $1 in and you've got $1 available for you. And so I'll go through those first couple of years kind of painstakingly and just make sure that people understand it. So that's kind of how I explain it, right? I kind of go slow there. But then also, right, is what I'll do is I'll jump down to year 10, year 15, and year 20, and I'll say, listen, what is our premiums? How much money did you put in, and how much cash value, how much did your cash value grow by? And a lot of times, usually by, I don't know, year 15 or so, you put in $1 and you've got $2 that's available for you, right? And so I'll make sure that they understand that. And so when you look at in regards to that, this is hands down one of the best systems that you can create. And I will say this is, I know I've shared this with you, but again, I think real estate investors get this pretty quickly, right? Is because what they do is they look at it from a cash flow perspective. And what I'll say is, man, if you were to go buy a $100,000 asset and you put in, or you purchased a house for $100,000 and it cash flowed $65,000 the first year, would that be a good investment? Right? How about the second year if you went and you bought another one, and the second year that thing cash flows $75,000 for you? And how about the third year you put in $100,000 and now it cash flows $90,000 for you? And the fourth year now it's just cash flow positive, right? And when you put it in that perspective, because investors are thinking on that cash flow basis, it makes sense, and I think that's why we're kind of have our niche that we do.
Yeah, and our ad, infinite banking is not a life insurance policy. It's how you use a policy. So when you look at that illustration, one thing that's not accounted for in there is, what if in year 1 you took some of that money and bought a cash flowing asset and you use that cash flow to pay off the policy loan? Then once that loan's paid off, you have all the money in your policy and you have a cash flowing asset. Like, that is, unfortunately, we can't illustrate that through the illustration, but there's more to it. Your policy, just what we talked in our last podcast, difference between savings, investing, and speculating. Your policy is savings, which will allow you to invest.
And the other analogy that I'll share with clients when we're talking about kind of the slow start is the idea of a marathon, right? Anthony, if I were to come to you and I would say, listen, I'm a coach, and if you were to let me coach you to run a marathon, I can guarantee you'll win. Would you like that idea?
Well, what I don't like is me paying you to train me in anything. But if I can get my ego aside, if you could guarantee I'd win, I'd hire you.
Awesome. All right, so perfect. So here's the deal, right, is I will guarantee you win, but what's going to happen is the first 7 years is you are going to be in last place. The first 7 miles, you're going to be in last place. Are you okay with that?
Yeah.
Okay, perfect. By mile 10, what's going to happen is you're going to catch the competition and you are going to pass them and you will never look back. Are you okay with that?
Yeah, I'm all about the bottom line.
Okay.
At the end of the day, I want to be in first place.
Perfect, right? As a potential client, you and I could work together, because I've had some people say, listen, I don't want a slow start. I'm only worried about today. And typically that doesn't work for us, right? So
kind of what you're saying, at the starting line, I'm going to be in last place. But when I cross the finish line, I'm going to be in first?
Correct.
Sign me up.
Absolutely. So that's kind of the analogy, right? Is as long as we're looking kind of long term when we embark on this IBC strategy, then we're in good shape. Anthony, anything else you got to share there?
No.
No? Wow, surprisingly. Got nothing to say. All right, awesome. Let's move on. Let's look at the second one. Kind of our second takeaway that we had after reading The Cost of Acquisition is really what came to mind is a couple of quotes from Robert Kiyosaki. Mm-hmm. Right? This is always a topic of conversation. His two big quotes, which is cash is king versus cash is trash. So what are some of your thoughts there, Anthony?
I think it boils down to having access to money. Like, so let's use the example that you have money inside a policy and I have money inside a savings account.
Okay.
Because I think that's what they're really, when they say cash is king, they're talking about the access to liquidity. But when they say cash is trash, I think what they're referring to is cash in a savings account.
I agree.
Right? So if I have money in a savings account, I would agree that that's trash.
Why would you say that?
Because I'm earning less than inflation, which means I have $100,000 in my savings account. A year later, I might have earned a couple bucks, but I've lost the buying power. So I can't buy what $100,000 could buy at the beginning of the year because of inflation. I can actually buy less. So maybe I made a little bit of interest, but at the bottom line, my buying power is less. Now, but you have money inside a policy. How would you compare that to what I'm doing? I
would compare it much better than to what you're doing.
And why? Why?
The reasons why is when you've got cash inside of a policy, right, is number one is you got complete access to it, right? So as far as...
Which I do in my savings account.
I was going to say, just as far as accessibility and liquidity when compared to cash, right, it's a wash in my opinion. I don't see any difference there. But also what I've got is I've got creditor protection, right? So for business owners, that's a huge subtle piece. But I'm also earning a much higher interest rate than you are, right? Mm-hmm. If you look at what people are earning in banks, 0.01%, right, in checking savings accounts. Sometimes you'll find an online bank that might give you a percentage point or two, but typically what you're going to find inside of a policy is around 4%. Mm-hmm. So it's much greater.
Well, also that 4% is...
I knew you were going to say it.
Of course.
Say it.
Is tax-free,
oh,
right?
Yes, absolutely.
Right? If I'm earning maybe a point, let's just say I'm earning 2, okay? But that 2% is taxable. You're earning more and it's tax-free.
Totally agree. And the other big piece that would be a separation of the difference between them is the fact that when you've got cash in a policy is that you've got that uninterrupted compound interest that's working for you, right? And so, man, this is difficult for people to see or to understand is that, man, when you have a dollar that's inside that policy, is that dollar just, when you take it out in cash, it stops earning for you. Right? So when you take the cash out of your checking account, it stops earning for you today. It stops earning for you tomorrow. It stops earning for you for the rest of this year and for the perpetuity into moving forward. And so that's why compound interest is so powerful when we use these policies is you can put it in there, take a loan against it, and you've got that money just continuing to earn for you every single day, every year, as long as you live.
And I think we have a couple videos that I think dive deeper into the numbers and will illustrate the power of using the infinite banking concept. And one would be, we have the great title, Cash versus Infinite Banking. Mm-hmm. And in there, we actually run some numbers comparing, putting the same amount of money into a savings account and buying one asset, or putting that same amount of money inside a policy and buying that same asset. And really, just as Cameron said, it's all about the bottom line. Or actually, I think I said that. It's all about the bottom line and how much cash are we going to have at the end of the day. And so we're put a link to that video in there. And also for our real estate investors, we did another video about just kind of the example is there's a house that we could buy for $100,000. I pay it for cash. And so I drain my account and buy the asset. Cameron has a policy. He borrows against his policy and buys the asset. So we're buying the same asset, but what we do is we kind of go through behind the scenes, and at the end of the day, at the bottom line. Because in my example, I don't have a loan to repay. So my cash flow at the beginning may appear a little higher. But also but Cameron has a policy loan repayment. So at first glance, you may think that the cash is going to be ahead. But again, we're not taking into account the compound interest that Cameron is continuing to earn in there. So I would check out that video. We call it the and one whole life with real estate. And we go in the numbers. And this really shows you the numbers. If you're going to buy real estate, the advantages of running it through a policy.
Awesome. Guys, I hope you enjoyed this conversation. What we just talked about was the cost of acquisition in really two pieces. One is we addressed the slow start, which we addressed with everybody. And then also number two was really that liquidity piece, right? So hope you guys enjoyed it.
Make it a fantastic day.
Take care.